Thank you, Kimberly. First and foremost, I want to thank you guys for having me. This is one of my favorite things to do is educate people on this subject matter. But fair warning, save the stones till after, and then I'll answer any questions, and maybe I'll change your mind on a couple of this stuff. By no means am I trying to be antagonistic, but there's also a lot of information in this. And I always tell people all the time, in order to understand cryptocurrencies, you have to often understand the problem so you can understand the solution and the things that it's trying to do. And by the way, if you see me up here not very expressive, it's because I've got an earache, so I can't really smile a lot, but I am functioning, so I can do a lecture here. But as she was saying, I've worked with the Oklahoma legislature on legislation in 2019 around this subject matter. And then even recently, there's some legislation that is going through the Capitol about Bitcoin mining. And what people don't realize is this evolution and this, I guess, revolution, I should say, is not just about money and currency. It's about the monetization of energy. And Oklahoma and Texas specifically are positioned in a very unique place to benefit from this industry and bring a lot of capital to the state and a lot of new business and a lot of new jobs. So I think what you're going to see in the coming years is the light bulbs are going off in the energy companies, especially the oil and gas companies. You have ConocoPhillips, which is now mining Bitcoin. You have places where they've got natural gas and they're capturing this flaring that's bad for the environment. They're turning it into electricity and they're monetizing this wasted energy, which is bad for the environment, and turning it into cryptocurrency through Bitcoin mining. So it's very supplemental, it's very profitable, and it can actually help the environment contrary to what you might be hearing through the mainstream media. And then also it can help with a lot of problems, which I'll dive into that here in just a minute. I'll do my presentation. But the first question you might be asking yourself about cryptocurrency is like, what's the big deal about it? Why is the world embracing things like Bitcoin? And I kind of broke it down here. These are just some quick bullet points. Each one of these bullet points deserves much more than just a phrase. But number one, a lot of people are getting into it because they see it as an opportunity to make some profits. Historically, for most of its history, for 13 years, it's been a non-correlated asset to your traditional markets. That has changed a little bit due to institutional money and financial institutions getting into cryptocurrency and Bitcoin. They're treating it much like a risky tech stock, which is actually the wrong way to treat it. But as the knowledge increases and these investors become a little bit more savvy with what they're dealing with, they're going to start treating it a whole lot differently than what they are right now. Number three, it's a hedge against a failing and finite fiat money system. Essentially, it is a digital gold. It's decentralized. There's no central party. It's controlled by nobody. And this is a fun fact. If you use this technology right, it can be unconfiscatable. And if you actually look up the word in the dictionary, unconfiscatable, it's not actually in the dictionary, because for all of human history, we've been able to confiscate assets either through theft or through the government or whatever means you have. But it's also an open source system that provides trust. So basically, it's a system of consensus. You don't have to trust it. You can actually verify. This thing is completely open. It's audible. People can audit it, and they can see how it's working. You can know what Bitcoin's going to do, when it's going to do it. And it's basically a giant experiment in monetary policy. It's a democratization of money. Essentially, it is an internet of value, a peer-to-peer network. And people don't realize this, Bitcoin and its network is the most secure computer network in the world. So it has real utility value when it comes to translating information or, I guess, digital value across the world. In its 13 years of existence, the blockchain, which is the underlying technology that makes it possible, has actually never been hacked. It is the hardest form of money in the world. It's limited in supply, and you might be thinking, Matt, how can you say that? It's digital. Well, for the first time in human history, the technology, blockchain technology, which is the underlying factor, creates the ability to have something be digital, but also scarce and original. That's never happened before. In fact, we're so used to copying and pasting digital information that we don't assert a lot of value to digital information because it can be so easily reproduced. With this, that's not the case. So an example for gold, if the demand for gold rises, capital comes into the market and more of it is mined, there's a lot of incentives to ramp up production. Even though gold is limited in supply, they can still ramp up production depending on demand. With Bitcoin, it's not that case. There will only ever be 21 million of them, which have been programmed into the system. And I will explain how that works and how it's prevented from expanding how much is actually in circulation. But when the demand for Bitcoin goes up, you can't increase the production. So the number or the dollar value has to go up. And then it's basically the world's first open source global monetary network. It is permissionless. I don't need permission to run a full node. I don't need a permission to download a wallet and use the network. I don't need permission to mine it, to participate in its creation. And then also, it has first mover advantage. It has a true network effect or game theory, which is playing out right now. And it is a apolitical money birthed by the free market. So it is a bottom-up approach to money instead of a top-down approach to monetary policy. And there really is no agenda. It is truly decentralized, ran around the world by millions of computers all at the same time. So in summary, Bitcoin is valuable because it's the world's first peer-to-peer, decentralized, and unconfiscatable asset built on the world's strongest computer network. It's the safest and smartest tool for transferring value in a digital age. Bitcoin can create personal monetary sovereignty. So you might be asking, how does this actually work? How does the blockchain produce new Bitcoins? How does it make it scarce? Why are people participating in this network? And I could explain it to you, but I find it very beneficial to provide visuals so you can actually wrap your mind around this. So if you want to turn your attention to this screen or this screen, this gives a great animated explanation of how the system and the network actually works.
So how does it work and what's the point? Cryptocurrencies like Bitcoin allow people to transact with each other using the internet anywhere on Earth. Instead of having an account number like a checking account or a credit card, cryptocurrencies are much more secure because they have a public key and a private key. It's like having two account numbers, one for deposits and another for withdrawals. You'll often see them displayed as a string of characters or a scannable code. This level of security means that you could put your public key on a billboard if you wanted to, and your funds would still be secure. The only thing other people can do with your public key is send funds to you. It's your private key that gives you access to your funds. As long as you keep control of your private key, your funds are absolutely safe and theft and fraud are virtually impossible. But, just like cash in your wallet, you need to keep it safe to prevent it from being stolen. Its security is entirely your responsibility. Cryptocurrencies can also give you privacy. Just like cash, you don't have to disclose any personal information when you spend them. By contrast, a credit card has your name, account number, and expiration date. These act like a public key, but the equivalent of your private key, your signature and security code, are displayed in plain sight. This is just plain stupid. I've toured 5 national money museums, and while I was at one of them, I saw a group of young students on a school outing. I can just imagine that someday in the future, a group of kids will be standing around the credit card display, pointing and laughing at the incredible stupidity of the system we once used. And this is the point. Cryptocurrencies are light years ahead of our current technology. Since Bitcoin was the first cryptocurrency, I'm going to use it as our example, and I'll expand on our earlier description of a distributed ledger. But first, where does Bitcoin get its value? Bitcoin is brand new to mankind in that it's both a currency and a payment network simultaneously. And this is where Bitcoin gets its value. The immense network of computers all around the world running the Bitcoin distributed ledger. Every second of every day, these computers are keeping the ledger updated and in full consensus via a system that incentivizes them to process and confirm transactions. The system that Bitcoin runs on is called blockchain. Think of it as a modern version of an old-fashioned bookkeeping ledger, but instead of a handwritten list of entries and calculations, a blockchain is a digital list of entries and calculations. A block is simply a bundle of transactions. Think of a block as a whole page of transactions in the old-fashioned ledger. A blockchain is just a chain of blocks. It's the same as a whole series of pages in the old-fashioned ledger. Easy, huh? Here's how it works. The Bitcoin blockchain actually exists in every one of the millions of computers on the network as exact copies of each other. However, for this example, so that we can zoom in and you can really see just how a blockchain works, I'm going to show it as one giant blockchain in the middle of a small network of computers. Let's follow a pizza transaction with Bitcoin. When the transaction occurs, it first appears on the network in a pool of unconfirmed transactions, along with thousands of others from all around the world. Millions of different computers from the network then gather some of these transactions and place them in their own blocks. The computers are all creating blocks constantly in the hope that theirs will be the next one added to the official chain. A new block is added to the chain every 10 minutes or so when one of the computers wins the right to have its block recognized as the next in the chain and is rewarded with a prize of newly created bitcoins. The way a computer wins the prize is by trying to guess the answer to an extremely difficult math problem. In fact, the problem is so difficult that even with millions of computers making guesses billions or even trillions of times per second, it still takes roughly 10 minutes to find the answer. Once one of the computers guesses the correct answer and wins, all of the millions of computers on the network that did not win are instructed to throw away all the work they have done, update their ledgers with the block from the winning computer, and start again with a new math problem. In doing so, the computers use an immense amount of power and cost a literal fortune to run. So why do they do it? Because it can be very profitable. This is where the term mining for bitcoins comes from. Instead of striking gold by mining for precious metals in the wilderness, these computers are hoping to strike Bitcoin by mining precious numbers on the blockchain. But when these millions of computers are selecting transactions to go into their blocks, they aren't all selecting the same transactions, and not all the blocks are the same size. Some contain more transactions, some contain less. When blocks are thrown away, the transactions they contain go back into the pool of unconfirmed transactions. This means that the probability of a transaction being confirmed and staying in the order it was confirmed in is not absolute, but it becomes more of a certainty every 10 minutes as new blocks are added. In fact, for very large transactions, it's suggested that you wait for 6 or more blocks, about 60 minutes, to be absolutely certain that a payment is permanent.
So that right there is a visual explanation of how blockchain technology works and what creates the ability for cryptocurrency to do what it does. The thing that you guys have to keep in mind is whether it's JP Morgan, Goldman Sachs, Morgan Stanley, BlackRock, Fidelity, or even nation states like El Salvador, all of these institutions and countries, and there's other Latin American countries that are looking to legalize Bitcoin as a legal form of tender. But the reason why these financial institutions are getting involved, some of the world's largest institutions are getting involved in this space, is because they know it's going to be extremely disruptive to their business models. And if they don't adopt it today, if they don't start learning today, they're going to be left in the dust. And I'll give you an example. Vast Bank is based out of Tulsa. They've got chapters, or they've got locations around the country. They were the first bank in the country to actually offer custodian products and services around cryptocurrency. You can buy and sell cryptocurrency hand in hand with your regular checking account through their app. So I had them on my radio show. I've had many conversations. A lot of bankers have been very interested in this technology, and I've had a lot of conversations with many of them. And actually, fun fact, the chief technology officer of Vast Bank actually in college helped contribute some code to the SHA-256 algorithm that actually is a part of Bitcoin's blockchain. So there's, oddly enough, Oklahoma, there's a lot of movement. There's a lot of people who are heavily invested and involved in this space. But just as the internet took market share from multiple industries, so will blockchain and cryptocurrencies. Money is the first use case for this technology, but it will eventually disrupt every corner of the global economy, and people will one day see the creation of the computer, the emergence of the internet, and distributed ledger technology as one event in history. The world is being decentralized and will build open peer-to-peer systems of mathematical trust with no middlemen involved. So essentially what cryptocurrency is going to do for money and value is exactly what the internet did for libraries and communications. So what we're witnessing is a monster transformation in our economy, and right now the whole market capitalization of cryptocurrency is roughly about $2 trillion. And to put it into perspective, the dot-com boom with the internet, the total market capitalization before that fell apart was $6.7 trillion at the top of that bubble. And that was primarily American money. Cryptocurrency is global investors, global money, and will definitely outperform and receive a lot. It already has faster adoption than the internet currently did when the internet was being adopted. So the rate of growth in this space is going to far outperform what we witnessed with the age of the internet. So the next slide here, this is you might be thinking, okay, how does this relate to money and why is Bitcoin considered money?
The question is, what gives Bitcoin its value? Why is one Bitcoin $50,000 right now? Why do people even care? Because it's just some people will say, well, it's just a digit, right? Well, not necessarily. There's a digit that represents it. But if you go back to Mike Maloney's videos that you're watching, the definition of money is essentially a vehicle that represents our time, energy, labor, and freedom, right? So we as human beings, the most scarcest thing on earth is our time and our energy. What Bitcoin does through its structure and mechanisms is it utilizes energy, the electrical grid. It requires large amounts of power to power these computers in order to solve mathematical equations in order to create it into existence. So even though it's not physical, it has a mining process that's very similar to gold and silver. If you're going to have a totally new economic system, and especially with the principles that Bitcoin has in its limited nature based off the code, right, Bitcoin is becoming digital gold. And so there's an evolution that takes place when something is becoming money, and that is first it's a collectible. Then it turns into a store of value, which is the stage that we're entering into. Then it becomes a medium of exchange. Then it becomes a true measure of wealth. And so we're in this evolution process with Bitcoin. And what Bitcoin is doing is it's a black hole sucking up the world's liquidity right now. And what it's going to do is it's going to become a life raft, a life preserver for purchasing power due to its limited nature and security on the network. And the best way to look at it is, it's, just like gold, like what gives gold its value? Why did we use gold? Gold we used as a store of value, which can essentially be a store of energy. So gold is a store of energy, and it takes energy to pull gold out of the ground. And that's why the utility and use case of gold gives it value, but also human perception gives it value. Without us perceiving that it has value, it really has no value. And so there's a couple components that give gold its value. And so what Bitcoin is doing is if gold is a vehicle that stores and measures energy over a long period of time, Bitcoin is doing the exact same thing, but instead of using energy to pull gold out of the ground, we're using energy for computers to solve mathematical equations to create this stuff into existence. So it's like a imitation of gold, but it's just for a digital world. Going back to that layer one solution, just like traditionally gold was our layer one money, our layer one store of value, then we built layers on top of gold. So what were our layers for gold? We had paper dollars, which were tradable, redeemable for gold. Then we had checks. Then we had credit cards. Then we had fintech like PayPal or Cash App, something like that. But with all of those systems, gold was still the base layer of store of value. And so Bitcoin is becoming that store of value level one base layer for the digital economy. because in a digital world, nothing is physically tangible. And I'm a big proponent of gold and silver, and always have been and always will be. And I will use gold and silver as a store of value because, let's be honest, gold and silver is God's money. It was here before we were here, right? So with cryptocurrencies, what Bitcoin is trying to do is trying to emulate the properties of gold and silver, but in a digital world. And as much as I love gold and silver, it's very hard for me to call my friend in Australia and say, hey, I'm going to send you 5 bars of silver and let's settle this transaction without A, a lot of money to send it overseas, B, government stopping me and taxing me. But what Bitcoin does is it takes the attributes of that, but makes it easy and permissionless in order to send value on a network that can't stop you from doing it. But it's a mechanism that stores energy and uses energy because it's pulling from the electrical grid or natural gas or something that's truly limited in nature in order to represent that energy.
So you might be thinking, cryptocurrencies, are they the future of the global monetary system? And what we have happening right now is 2 different systems. You have a decentralized system that's already in effect, and then you have organizations like the central banks or nation states that are rushing to create their own version of this technology so that way they can maintain control. What you have here is you have Mark Carney, who was the former governor of the Central Bank of Canada and England, basically said the dollar is too dominant and could be replaced by digital currency. Washington Post, why China is rushing to mint its own digital currency. They were actually the first nation state to do this, and you can probably wonder why social credit scores and all of that. But then you've got the Federal Reserve. The Federal Reserve in America is actually in pursuit and study of creating a digital dollar or a digital cryptocurrency version of the dollar. Many of the public officials have been on record. And then you might be thinking, why are central bankers looking at this? And to be honest, we have a couple of macroeconomic trends that are converging in our lifetime. And you can take my words to the bank on this. Before we die, our monetary system is going to change. There will be a default, a reset, a restructuring, however you want to classify it. So if you look at the first trend, the average length in which a country holds the world reserve currency is roughly 80 to 90 years, going all the way back to the year 1400. And America got that title of the world reserve currency directly after World War II. So if you do the math, we're getting towards the end of that. The second macro trend that's taking place is ever since the creation of the Federal Reserve, the dollar has lost 98% of its purchasing power since 1913. And the average lifespan of a currency, a fiat currency, maintaining value or use over the long term usually doesn't go past 50 years. And America, when we left any form of the gold standard in 1971, that was essentially a ticking time bomb. And so essentially we're coming towards the end of the lifespan of the dollar as a fiat currency. And then you also have to consider, I know Ray Dalio, a prominent investor, has been talking about the super debt cycle that's taking place, which happens every 50 years. That's another trend to consider. But the trend is very clear among the financial institutions. JP Morgan creates a digital coin for payments. Banning cash so you pay the bank to hold your money is what the IMF wants, which is the International Monetary Fund. Bank of America CEO says the company wants a cashless society. Wells Fargo to pilot a dollar-linked stablecoin, and I could most certainly describe what a stablecoin is during Q&A. But our monetary system will change and is changing. 40% of all dollars in existence today were created over the last 2 years. And people are talking about supply chain issues, they're talking about inflation, they're coming up with all these excuses of why inflation is happening. But the truth is, when you create that much money or new monetary supply and you throw it into the market, usually it takes 18 to 24 months for that inflation to start hitting. And so month after month, inflation is getting worse. I think we're sitting close to 8.5 right now. So if I were to be a guessing man, inflation will continue to climb. The IMF has been calling for another Bretton Woods moment, and the World Economic Forum has publicly stated and published a website that they want a great reset. So it's really up to us in what we accept. Do we want a system like Bitcoin that is free, open, fair, transparent, permissionless, and controlled by no one person, company, or government? Or do we want a CBDC, which stands for central bank digital currency, that is top-down, centrally controlled, inflationary, and will kill community banks and enslave the population? And I know that sounds extreme, but if you have a central entity or a cartel of banks, central banks like the Federal Reserve, creating a central bank digital currency, essentially what they're going to do is they're going to say, hey, we're going to roll out this new version of the dollar, go to our website, download this app, we'll give you $10,000 of the new crypto dollars. Well, if they start offering these kind of financial services through apps or through the internet, it really dilutes the ability for community banks to do what they're doing currently. So a lot of community banks are not in favor of a central bank digital currency. So to understand things like Bitcoin, we have to understand the problem first. The problem is the unconstitutional version of the dollar that we use today and how it has a finite lifespan. That's for a whole nother conversation. But in essence, that's it really helps you kind of drill down in understanding this space. Bitcoin is designed to be hard money, limited at 21 million coins. Each coin is divisible by 100 million, which is 8 decimal points. Fiat dollars are easy money and must be inflated to infinity due to its design. Bitcoin is a lifeboat from inflation. And what most people don't realize about our money system today, and this is not about fractional reserve banking or bank credits where most of the money is created, but it all starts at the Federal Reserve. And so if you borrow the first IOU or the first dollar into existence and you owe interest on that dollar, where are you going to get the extra dollars to pay for that interest? Well, you got to borrow again. So it's a perpetual system of debt. And so a lot of times you'll hear politicians talking about we got to pay down our debt, we got to live in our means, we got to take care of our deficits. It's really just a dog and pony show, because if we did take any measures in the current system as it's designed now to pay down debt at any substantial level and live within our means, the whole system would collapse in a deflationary collapse. So it's either a deflationary collapse or hyperinflation. Those are our two options.
But I have to start at monetary policy. We're talking the Federal Reserve and its shareholders, but, bear with me as I lay out my case. But yearly CPI inflation, which you're fully aware of, is up at a 39-year high of 7%. But if we were to actually use the same method of measuring inflation as we did in the 1980s, it would actually be the highest in history, with inflation at 15%. We know that the Fed is talking about raising rates and tapering asset purchases, which in translation, tapering means they slow down their creation or counterfeiting of money. And if you are listening to this program and you don't already know, it is money printing that creates inflation, which means your dollar loses value. And due to the way our monetary system is currently designed, you need continual money creation to keep it going. The catch-22 is this, though. The last thing that the Fed wants is inflation to go out of their control. If it does, there is a complete loss of faith and confidence in their paper currency, or AKA Ponzi scheme in my opinion. In fact, the Fed eventually wants to aim at bringing interest rates from 0 back to 2% by the end of next year, which would put us back closer to the rates we saw before the pandemic. But that's like spitting in the ocean. It's not going to do anything substantial, and it's often been said that you can't taper a Ponzi. I mean, I personally think that the Fed's painted itself into a corner, and they want to raise rates and taper money printing because they want to get inflation under control. That's exactly what the Fed did in the 1980s. They had to take big actions. Inflation was around 14% using the old method, right? And the Fed had to raise interest rates to 20% to help stop it. But by doing so, they also brought the economy to a standstill and a recession. Today, the markets are drunk on free and easy money and will throw a taper tantrum if the Fed does anything aggressively. If the Fed doesn't act aggressively, inflation continues, stocks and asset prices will continue to rise, and the confidence in the dollar erodes. However, if they do acts aggressively, then we are possibly talking about stocks crashing, major recession, and a reduction in economic growth, which the politicians don't want. I personally think the Fed is bluffing. Government deficits are out of control. Public and private debt levels across the board are at record highs. We're looking at a world of hurt, no matter which way this cookie crumbles. Jerry, how long does this game go on? Can the Fed really get things under control? Or are we at an inflection point with our monetary system?
Well, there's an old saying, markets can remain irrational longer than you can remain solvent. It's an old John Maynard Keynes quote. And one of the things he got right, that's so true and you make a great point about the Federal Reserve central banking scheme and how it has, in the name of monetary stability, wreaked havoc upon the people's dollar. I mean, the U.S. dollar, the medium of exchange. So there's two parties here. There's the one who's doing the abusing, and then there's the one who's being abused. And I believe that both have a responsibility. So the abuser in this case is the Federal Reserve. It's debauched the value of our currency through its reckless and nearsighted policies. And they are always shielding the large investor class from economic realities through their policies. And then the rest of us are left to face the music. But in addition to the abuser, you also have the abused. And in this case, the abused are those who hold U.S. paper dollars over a long time period. Matt, for those who were around back in 1971, they remember that the average house cost $25,000. 1971, the average income was $10,000. A new car cost $3,500. The average rent was $150 per month. A movie ticket cost $1.50. Okay, so who's abusing the system? Who's destroying and devaluing the currency? How did a U.S. stamp go from 8 cents to the cost that it is now? Gasoline, 40 cents per gallon back in 1971. So who's doing the debauching? Who's the abuser? And the question that every American should be asking is, what has the government done to our money? But until now, the American public, Matt, as you well know, has been largely silent, like frogs in the boiling pot, seemingly unaware that they face this ever-increasing hidden, or as some call it, a stealth tax in the form of inflation. So ultimately, the question may not be how long will the abuser abuse his victim. Perhaps the question we should be asking instead is, how long will the abused tolerate abuse from their abuser? When will they speak up? And I don't know when that tipping point comes, but it will come. Of that, I'm certain.
All right. Well, I will open it up for questions. If you got any. Maybe.
I have one.
Okay.
So we have a lot of business owners and local leaders here, and they deal with a lot of the transactions that apparently we will be laughing at in years to come. So how do we, being pretty uneducated as a community, how do we prepare for this in the business industries?
Right. So the first step is start educating yourself, because the more you know, the less fearful you are, and the better you can take action. The second point is, what we're witnessing is we're in the middle, we're in a unique transition. So we have two monetary systems, one that is coming to fruition and evolving, one that's been around for a long time. And there's a thing called Gresham's Law. And Gresham's Law basically states that the good money drives out the bad money. So a lot of people will come to me and say, Matt, what can I spend Bitcoin? What can I use to buy with Bitcoin? And I say, well, there's plenty of things you can use to buy, or you can buy things with Bitcoin, but I actually discourage it, because during this evolutionary process, the good money people will hoard and save as it appreciates in value, and the bad money will continue to decrease in value and people will spend it. So essentially what I actually tell people is, hedge yourself, protect yourself, buy hard assets, buy things that are limited in supply. You get something that's outside of the system. So when the system does go bust, you actually have a life raft. And I would encourage you, download a cryptocurrency wallet, set up a consultation with me, learn how this stuff actually works, so that way when the time comes and you do have to utilize something like this, you know how to use the technology. And again, do I think it's going to happen overnight? Not necessarily, but I do think it's going to happen in our lifetime. So I think what we're witnessing is this inflection point, and I would encourage anybody, whether you're in business or an individual, start learning, start educating yourself, because that's half the battle. Go ahead.
Your example of blockchain, talked about how when they solve that math question, they could issue 5 bitcoins, or who do they receive that from? Who's giving them the value?
So the issuing of the new Bitcoin is actually programmed. So Bitcoin is simply just an open source software. So based off of the consensus mechanism and the computers trying to solve this problem, what happens is you have miners who are the puzzle solvers, then you have the full nodes, which are the people who are running a full version of the ledger, and they're double checking the puzzle. So quote unquote, they're like the puzzle checkers. So essentially when the system comes to consensus that this computer, wherever it is in the world, solved the math problem first, or the SHA-256 algorithm, essentially they are getting rewarded with this new Bitcoin. And so the issuance of Bitcoin is actually programmed into the software to the year 2140. So 19 million of the Bitcoins in existence have been mined, and there will only ever be 21 million of them. And the last 2 million are going to be done over the next 100 years. And so every 4 years, what happens is the software is programmed to do what they call a halving. So every time a miner solves this problem and gets issued new Bitcoin, along with the transaction fees that are in that block of transactions, their rewards get cut in half every 4 years. So essentially that's how it works. No, there's not one central person or entity that's issuing these. Right. Yeah, so I mean, there's pros and cons to every system. One of the cons to cryptocurrency is you do have to be somewhat knowledgeable in multiple areas to kind of wrap your head around this, to be safe in it. And that's why I tell people there is a learning curve. Right? You remember when the internet came out, people were like, is email internet? Is internet email? Like, do I write to it? Like, how does it work? And so people had a lot of questions. And I remember my dad, it wasn't until 2005 that he started using email. And so there's going to be late adopters to this technology, but for the vast majority of people, you do have to educate yourself, find somebody that can teach you, because if you do the wrong things, you can lose your money. There are roughly 4 million Bitcoins lost forever, and that was primarily because in the evolution, which I mentioned in one of the videos, the collectible stage, there was a bunch of computer nerds and cypherpunks that were experimenting with this network and running these nodes and mining it, that they didn't really think it would become of anything. And so they just kind of left their private keys on these hard drives, and they got rid of these computers, and years later they were like, wow, I'm like multi-millionaire. If I could just go through this landfill and find this hard drive that has my private keys, I can actually move the money across this distributed ledger. So essentially, the money doesn't actually go away. It's just that if you lose your keys, it can no longer be moved across this distributed ledger. And so a lot of people, if they don't take, digital hygiene or internet security seriously, or they don't pay attention to what they're doing and they're just being careless, then yes, there is a risk factor. But the unique thing about cryptocurrency is it flips everything upside down and allows you to be sovereign over your own wealth and be your own custodian. Not everybody's going to opt in to do that. That's why people like Vast Bank in Tulsa are offering custodian services. And there are plenty of people who have large sums of money in cryptocurrency, which they will use something like a multi-sig wallet, which actually requires multiple sign-offs or signatures on a transaction. So a lot of times with a multi-sig wallet, you'll have maybe an institution hold one of the keys, you as the individual holds another key, and then maybe another party holds the other key. And so in order to move those funds, all three of those keys have to come together and sign off on the transaction. So this is a new and evolving space. So there are always going to be new services, new products, new wallets, new way of doing things. But yes, it is not void of risk.
Is the protection software that you just talked about, is that really going to be the only game in town for like banks and financial service providers?
Well, actually, no. So that's one of the services, but there's services that I use right now online, which work a lot like a bank. There's services in which you can actually borrow against your cryptocurrency. So, for instance, I've got some crypto. Okay, I've been in the space for 6 years, and I don't necessarily want to pay capital gains tax. And so, until the law changes, I can actually put up my Bitcoin as a collateral, and based on the loan to value ratio, it's an over collateralized loan. And so if one Bitcoin is $50,000 or $40,000, I can essentially take out a $20,000 loan. Banks could do that. Yes, in fact, Vast Bank is actually looking to do just that. Say that again. Let me get a little closer. All right. Let me. I didn't hear you, so I'm going to come.
So if you default, the bank that you have the loan through has to have the ability to take your Bitcoin.
Yeah. So you park your funds with them. So in other words, as a custodial service, you basically forfeit the right to hold the private keys. So it's kind of like having cash in my wallet versus giving it to the bank. So if I wanted to borrow against it, then I could, give it to an institution like a Vast Bank or like Nexo or BlockFi or some of these other services that offer these things. Right here.
Bitcoin's not the only cryptocurrency. What makes it superior than the other cryptocurrencies, and how will all the cryptocurrencies interface with each other?
Right.
So
there are multiple versions of a cryptocurrency. In fact, there's thousands. And here's the thing, 90% of them are going to fail. And that's okay, because what we're witnessing is a free market of competition, new developers, new ideas, new blockchains, new way of doing things. And the fun fact is cryptocurrency doesn't just act like a currency. This is where people get confused. We use the word currency as a blanket statement, but it can actually, with the distributed ledger technology, you could create a digital representation on the blockchain of company stock or debt, which is a security. You could create a utility token, which acts like a coupon or a ticket into some kind of digital ecosystem. You've got NFTs, which are non-fungible tokens, which basically represent either a real-world item or a digital item. And basically an NFT is simply proof of ownership. Basically, you can prove to somebody or a third party or another person that you are the unique owner of this asset. It's, for example, I could go to the museum and take a picture of the Mona Lisa, and I could have a copy of the Mona Lisa, but I can't prove that I'm the original owner of it and that it's authentic. And then you have the central bank digital currencies, which will happen. I have no doubt about it. I think nation states and central banks will roll out their own version of a cryptocurrency. Will I use it? Probably not. But that's up to people to decide and how they want to utilize these different networks.
Which ones do you currently trade?
So I hold probably about 10 coins in my portfolio. And when I go through my top favorites, Bitcoin, and to answer your second part of your question, the reason why Bitcoin is superior is because all of this new money, whether it's institutional or whether it's nation states or whether it's sovereign wealth funds, the reason why they're looking at Bitcoin is because it is the most secure computer network in the world. So if you're going to move billions of dollars into this new ecosystem, you want to make sure it's safe and unhackable. And people who talk about hacks all the time, those are third parties or exchanges that are getting hacked, not the actual blockchain. But there are other cryptocurrencies whose blockchains have been hacked due to lack of usership. So in essence, the larger a blockchain gets, the more full nodes, the more miners that are on the network, the safer it gets. So Bitcoin does have this network effect. It's kind of like why is Facebook and Twitter and YouTube and Google so powerful? They have network effect, okay? Anytime a competitor tries to compete against them, they've already got a fisthold on the game, and people, it's just easier to use. It's, safer in a lot of ways, but also you got your downsides with it. With Bitcoin, it's going to be that layer one, premium asset in which there is no counterparty risk. It's going to be the ultimate form of collateral, in my opinion, in this digital economy. So, people may not use Bitcoin on a day-to-day basis. I think there will be a bunch of people as time goes on that does it, but I think in this next 10 to 20 years, Bitcoin is going to be seen more as an asset with no counterparty risk that people can utilize as a store of value.
So people are putting in these multi-million-dollar mining facilities, and their incentive is to mine a blockchain, get Bitcoin, and then they also cash out on the fees, I guess, associated with each transaction.
Yeah.
So once all the Bitcoins are mined, will the income generated from the fees be enough to offset their overhead costs with all maybe the loan they had, the cost for the energy? Like, what's the incentive to keep them doing
Right.
to keep Bitcoin in existence?
So the incentive is miners are incentivized to find the cheapest energy, first and foremost, and the cheapest energy isn't always fossil fuels. But when it comes to the issuance of new Bitcoin, by the time we get 100 years down the road, and let's say Bitcoin is the new world reserve currency and people are actually trading energy assets in Bitcoin, you're going to see a lot of nation states and institutions using this as a settlement layer. And I think because there'll be so much capital, so much value, so much wealth in this network, that the transaction fees alone, once 100 years from now, will be sufficient enough to maintain the economic viability of the miners to keep doing what they're doing.
Two questions. How do you solve the power problem?
The power problem?
If you can't solve the power problem, is the current amount of miners enough to move Bitcoin past the dollar?
So the power problem is, your assumption is that it'll use too much power?
There's not enough transmission capacity in the country.
So in the current state of the grid, this is where Bitcoin actually will help society. So because Bitcoin incentivizes miners to find the cheapest energy, historically, we've been able to build societies around where energy was easy, cheap, and accessible. You have civilizations building on rivers or ocean sides or around these unique areas where energy is I guess, readily available. Well, what Bitcoin does is you can actually go to remote locations, whether it be solar panels, a hydro dam, wind. You can tap these resources in remote locations where it's not viable to transport this energy from point A to point B, monetize the energy to make it to where you can actually start to tap these energy sources where you couldn't before. So the ability to expand our energy consumption will grow because of Bitcoin. And have you ever heard of the Type 1 and Type 2 and Type 3 societies? So Type 1 society, I can't remember who came up with this, but a Type 1 society is where a civilization is able to harness the entire energy capacity of their planet. Type 2 is when a civilization is able to harness the power and energy of their solar system, and then Type 3 is their galaxy. And so I really don't think, just because we're talking about the energy situation as it is now, and I'll use Texas as an example. So Texas, they had that ice storm, they had the grid problem, and it was a major catastrophe. Well, Governor Abbott and a handful of other politicians have jumped on the bandwagon of Bitcoin mining because they've seen not only the benefits of these energy companies utilizing Bitcoin mining, but also to alleviate the problems with the grid. So for instance, when these miners plug into the grid, they're basically creating new demand for this energy. Energy ramps up, and then once there's an issue like they had with the ice storm, the miners can simply just turn off their machines, and now it alleviates the problems that they had before because these miners are no longer using the energy. So it almost acts like a battery in some ways. There's not a whole lot of things that you can just turn a switch on and off to help alleviate some of those problems. So I don't necessarily think the energy consumption is a problem, and I think a lot of people misconceive, they equate energy consumption to carbon footprint as well, and that's not necessarily true as well. Because essentially, energy from the sun, wind, hydro, it's unlimited in a lot of ways. Right here?
You said that there's thousands of cryptocurrency companies, and 90% of them are going to fail. So what happens to those investments? I buy Bitcoin and it fails. What happens? I lose my investment, I guess.
Yeah, I mean, if you invest in the wrong project, I mean, it's no different than what happened in the internet. I mean, even though these aren't companies, these are networks. You're basically, the equivalent that I make is in the 90s and the early 2000s, you were buying shares in a company that was providing services and products on the internet. Cryptocurrency, you're actually buying a piece of the network itself. And so there's no, and there are more centralized cryptocurrencies and there are more decentralized ones. It's kind of on a spectrum. Bitcoin is the most decentralized. But essentially, if you make the wrong investment decision, you'll lose your money. Just like, for instance, people invested in pets.com, people invested in amazon.com. The people invested in pets.com, not so good. People invested in Amazon, probably doing pretty well.
Would you be willing to share your video, your PowerPoint, and those video vignettes?
Yeah, I mean, I could share. I mean, I've got tons of video content on all my websites. I'm more than happy to share whatever. So, yeah. Anything else?
You said you were going to say more about stablecoins.
Oh, yeah. So, stablecoins. So, stablecoins are a unique thing. So, if there's two things that regulators care about right now, it's stablecoins and the security laws, right? So, the stablecoins are kind of unique because you have this third party that's taking dollars or euros or gold or any other kind of an asset, and they're backing these digital tokens one for one. So, and a lot of people will utilize these stablecoin networks because you don't have the daily volatility in its price fluctuations as you would with something like Bitcoin that's, going up and to the right. Despite its ups and downs, its higher highs and higher lows. But with a stable coin, if it's backed by $1, it's going to pretty much stay at the value of $1 that day, that week, that month. And so a lot of people will use this for international transactions between peers. They will use it for trading. So a lot of traders will open exchange accounts and they will use these stable coins and they will park their funds in these exchanges. So when they're ready to swoop in and make a buy or a sell, they're utilizing these stable coins so they can lock in their profits and be pretty nimble. But the stable coins are controversial because it undermines the current banking system a whole lot more than what Bitcoin is doing. Because what Bitcoin, right now a lot of the regulators, whether it be SEC or other government officials, they see Bitcoin more as an asset and the IRS treats it as such. But these stable coins, you can basically circumvent the entire SWIFT system. Well, you could do that too with Bitcoin. But the problem is with Bitcoin is even though it's appreciating in value, one day it's $50,000, the next day it's $45,000, and then the next day it's $60,000, and then the next day it's $50,000. So with the stable coins, you just get a little bit more of that consistency in price. Anybody else? All right. Well, thanks, guys. Hopefully it was not too much.